Today, I will be taking you through the text part of question 2, and the related parts are part A, part B, 1 and B2. Just to give you a brief background about the company, which is Jody Pty Ltd, we will just go through some highlighted information in the question, and the rest you can go through yourself. So these are the key issues that you need to note when doing the text part of the question. So Jody is a company that manufactures, or that rather produces, ice cream and is sold in bulk to wholesalers, and all its income is derived from such sales. And then the company, since in its incorporation, it expanded to include various cones, lollies, and other goodies related to ice cream. And then the company distributes to major cities in the country. Just one interesting thing to note there, but it wasn't really relevant for the text part, is that they are considering introducing an online platform as well as making use of the drones to deliver the products. The company's revenue has been growing. However, like most companies during 2020, due to the COVID pandemic, the revenues declined a bit there. So what you really need to note for the tax is that the company is a South African resident for tax purposes, and then its year end, it's 31st December. And then the process of producing ice cream is considered to be a process of manufacture, which is very key when determining your capital allowances. And then it is a small business corporation in terms of Section 12 Cap E, which means that they would be entitled to special capital allowances. And then the existing finance structure of the company is that Joe is the sole shareholder of Jody, and he contributed 8 million as consideration for acquisition of 800 ordinary shares in the company. And to confirm that it is indeed a small business corporation, Joe does not own any shares in any other company. And then the amount that was raised by Joe was used to purchase capital and for the operations of the company. And then the company had obtained the following loans in addition to the money that Joe invested. Firstly, it's a loan from Starbank, a loan of 5 million with the terms that the effective interest rate is 10%. The interest is calculated and paid at the end of each calendar month. The principal amount is repayable on the 31st December 2028, which is about 8 years later. The loan is is subject to a covenant that the company's long-term debt to equity ratio may not exceed 50%. And then should this happen, then the loan becomes repayable immediately. And the purpose of the loan was to acquire equipment that is used in the production of the ice cream. And the equipment was brought into use on the 11th of January 2019. The full cost was 5 million, which is the amount of the loan. So you will note that the equipment was brought into use during the 2019 year of assessment. And then the company was able to claim the allowances in terms of this equipment for the 2019 year of assessment. So just note that the amounts exclude VAT, so you do not need to take out the VAT. And then the second loan was financed from commercial asset financiers. Jody purchased an industrial freezer for 1 million that was brought into use on 15 October 2019. Note, still within the 2019 year of assessment. And then the purchase was financed by means of a credit facility obtained from CAF, which is Commercial Asset Financiers. And the terms were as follows. It bears effective rate of interest rate of 12% per annum. Interest is calculated and paid at the end of each month. And the capital amount is repayable on the 14th of October 2024. In addition, CAF is a financial institution, and it provides finance to small and business and medium-sized enterprises. CAF has previously converted debt to equity for its clients when necessary. So this should already give you an idea. Remember, the company is experiencing loss in revenue, and then there's a talk of converting debt to equity. So you should now start thinking about all the applicable provisions in the Income Tax Act for converting debt into equity. And Kev and Jody are not connected persons as defined in Section 1. Here again, the cost of the freezer was claimed as an allowance during the 2019 year of assessment. And then number 3 talks about the packaging equipment. So remember, this is another equipment. Initially, we had, what was the first equipment? They purchased equipment. It's just said it's equipment used in the production process. And then the next one is the freezer. So here, this is the packaging equipment. The information is given there, but what you need to note for the text is that Jody will have to purchase a packaging equipment. So you need to make note of that. And then Jody has 2 possible sources for the purchase of packaging machine. So they could purchase the packaging equipment from local supplier at 1.3 million, excluding VAT, or they could import the machine. And Anita favors importing the packaging equipment since the company usually struggles for a long time to claim input tax. So here you have an idea of where they will get the packaging machine or packaging equipment. Number 4 refers to the financing now of this packaging equipment that they need to purchase. Jody does not currently have the necessary funds to purchase the packaging equipment, and they therefore need to obtain further finance. So remember, initially the company had a debt covenant where they shouldn't exceed 50%. So now they negotiated the following terms. The existing 1 million loan with KEF, as read previously, will be converted into equity by Jody by issuing 200 ordinary shares for 20% interest in the company. And as a result, the debt will be fully settled. And then the market value per share would be 4,000 of these 200 shares. This would also be the market value immediately after the conversion. KEF will further provide a loan of 1.3 million to fund the purchase of the packaging equipment. So at this point, we will go to the required to see what was expected of the candidates. So part 1 is a discussion. It's discussed whether the interest paid on the loan from Starbank is deductible by Jody for normal tax purposes. And then B2 wants you to explain again, these are just discussions, what the normal tax consequences would be for Jody if it opts to convert the existing loan into 200 ordinary shares. So key here, you are asked to discuss the normal tax consequences. We don't want to see VAT or anything that is not normal tax. And then part B2 wants you to explain whether the normal tax consequences would change for Jody if the existing loan from KEF was written off instead of being converted into shares. So let us now go to the solution to see how the question should have been responded to. So question 2, let me quickly get to question 2 part. So question 2, part A, as we've already seen, discuss whether the interest paid to Starbank. So now we need to get to the information relating to Starbank. So what you needed to identify was that the basic tax principle that if there's a special provision for a deduction of an amount, you have to deduct or you have to consider the requirements of that special provision before going to 11A. So in this case, you had to identify that 11A is not applicable because there is a specific provision, which is your section 24J. And then the next point is to identify that in order for you to get the deduction in terms of section 24J, the amount has to be incurred for trade purposes and the production of income. So in this particular question, trade wasn't really the issue. It is clear that the company Jody is trading. So you had to identify if it is indeed in the production of income. And then what you also had to identify was that Jody in this case was the issuer of the instrument. There is an instrument and Jody was the issuer. So the bank would have been the holder, but we are asked for Jody. So Jody is the issuer as they incurred the interest and they have got the obligation to repay the interest to the issue. The issuer has the obligation to pay. So as I indicated, you had to prove production of income. So you had to get to a point of discussing the loan that resulted in the incurral of interest was closely connected or a necessary concomitant of trade. So here is the identification of the principle of the PE framework. So the first mark was for the identification of the principle, and then the second mark was for the application. So it is very clear that the purchase of the equipment was for the production of ice cream, which is the business of Jody. So as the loan was used to finance the purchase of equipment, that is used to manufacture ice cream, which is its ordinary business, then it is in the production of income. And then the last easy mark was for you to conclude on whether this is deductible or not. But very key, as we have identified that this is a 24J deduction, you have to conclude in the context of 24J. As you can see how the solution is structured, we have ruled out 11A and then concluded based on 24J. So if candidates discussed 11A and then concluded in terms or in the context of 11A, they would not get the mark, the conclusion mark, because it is an incorrect conclusion. So just key there, it is in the context of section 24G. And then moving on to part B. Part B required you to explain the normal tax consequences if the loan was converted into ordinary shares. What was key, remember initially we said Joe does not hold shares in another company. So what you need to know is the requirements of section 12 cap E. And one of the requirements is that all the shareholders need to be natural persons. So the moment that a company holds shares in that previously small business cooperation, then it stops being a small business cooperation from that day. So this question was testing that principle, because once the shares are converted, then it means CAF would have interest in Jody. So they would hold the 20%. Let me quickly go to that point where it's discussing the 20% in the company. As a result, the company would lose its small business cooperation nature. It becomes a normal business or a normal company that will be taxed at 28%. And the acquisition of the new packaging equipment, because remember, all this transaction is done with the purpose of purchasing a new packaging equipment. It hasn't been purchased yet. So the moment that Jody stops being a small business cooperation, then they will no longer get this section 12 cap E accelerated capital allowances. So number 4 refers to a point that the new packaging equipment will not qualify for section 12E. However, it can qualify for section 12C. So if you had raised any of those points, you would have gotten a mark. The next key thing for this part of the question was to identify that the conversion of a debt into shares leads to a debt, a concession or a compromise as defined in section 19.1 and paragraph 12A. So this mark was for identifying that fact. And then the next point, you had to identify the amount now of the debt benefit. And in terms of the act, the amount that is, you look at the face value of the debt and the market value of the shares. So if the debt exceeds the market value of the shares, then you would have a debt benefit. In this case, remember, the loan is 1 million. And then the market value of the shares is the 200 ordinary shares times the 4,000, which gives you 800,000. So the difference between the 1 million and the 800,000 gives you a debt benefit of 200,000. What you needed to identify, or what the candidates needed to identify going forward with section 19 and paragraph 12A, was that paragraph 12A and section 19 would not apply, as the debt being converted to shares, and it is the original amount and not the interest that is converted. So remember, this is what was applicable in 2020 year of assessment. So SARS has provided an interpretation note to clarify this, which relates specifically to interest. So basically, if they had written off only the interest or converted only the interest, then you would look at section 19 and 12A. But in this case, it is the original capital loan that is being converted and not the interest incurred. Therefore, it rules out section 19 and paragraph 12A. However, you needed to go to section 19 and 12A and disprove it and then go out of it. So now when looking at 5.3, the original loan and not the interest is being converted, as I said, sorry, number 4. As a result, the obviously the contributed tax capital will increase by the 800,000, which is the market value of the shares, and 5.5 talks directly to paragraph 19 not being applicable. I mean, section 19 and paragraph 12A. The debt benefit of 200,000 will not be treated as a recoupment, because section 19 and paragraph 12A do not apply. Remember, section 19 and paragraph 12A deems the amount to be a recoupment. Here, the alternative was provided in the suggested solution, where the candidates did not identify that section 19 or paragraph 12A are not applicable. So if you didn't identify that and identified it as actually being applicable, then you should conclude by saying the 200,000 must be treated as gross income must be treated as a recoupment to be included in gross income. So that is it at number B1. Number B1, you had to identify that there is the conversion actually changes the tax nature of the small business corporation into a normal company or into a normal corporate that is taxed at 28% and does not get special allowances in terms of paragraph 12E. Once you are done with that, then you had to identify the concession and the loan and go into section 19, paragraph 12A. And then once you've disproved it, I don't know if that's the correct English word, then you go and conclude. Okay, and then in terms of B2 basically wants you to think about a scenario where the debt is just written off, meaning CAF would not have any shareholding into the small business corporation. What you had to identify was that this is obviously, if you had correctly identified B1, then you can also identify in B2 that the nature of the company would not change. Basically, the small business corporation will remain the small business corporation. And then number 2, you'd have to identify here the value of the debt benefit would be different, because if the debt is just fully written off, then the amount of the debt benefit is the amount of the debt being written off, which is the 1 million. And then the loan, you should identify the purpose of the loan. So the 1 million loan was incurred in respect of the freezer, as it is an allowance asset that was not disposed of prior to the debt arising. So remember, in terms of paragraph 12A, you have to identify whether it is an allowance asset or a non-allowance asset that was acquired with this debt. So the purpose of the debt is very key for you to determine. And then in terms of 12A, What it means is that because the asset is still in existence, you have to reduce the base cost of that asset with the amount of the debt benefit. So let me quickly go back to B1. Oh no, sorry, B1 we disproved 12A, so we didn't need to even go further. Okay, now here, once you have discussed that the amount or the amount of the debt benefit is used to reduce the base cost of the asset. But now remember, the information said the freezer was fully written off. So you had to identify, because the principle is that you reduce the base cost of the asset. However, you look at this base cost. This base cost is sitting at nil at this point. So what it means is that the debt benefit will be treated as a recoupment because you cannot reduce the base cost any further. And then that amount will be included in gross income. And remember, we are doing all this to purchase packaging equipment. So the acquisition of the new packaging equipment will still qualify for Section 12E and gets the 100% allowance, unlike in the previous question where it will no longer qualify for 12E but might qualify for Section 12C. So that is what was expected of the candidates in this part of the question. Thank you.